September 17th, 2001. The stock market plummets. The Dow Jones loses 684 points in a single day, a historic drop at the time. Exactly 7 years later, September 29th, 2008, it happens again. The Dow falls 777 points, another massive market event. Fast forward another 7 years to August 2015. Global stock markets are in turmoil, and the Dow experiences extreme volatility. And exactly 7 years after that, in 2022, markets undergo major corrections, stocks fall, and economic concerns dominate the headlines every 7 years. With remarkable consistency, major financial events, economic disruptions, and market volatility seem to strike. This isn't just random noise. This is a pattern. A pattern so consistent, so regular that it demands a closer look. And the explanation might be more fascinating than you think. Before we dive into why markets seem to shake every 7 years, let me know where you're watching from. Drop your country in the comments. And if you're ready to find out whether economic cycles follow an ancient blueprint, hit that subscribe button. Because what you're about to learn could change how you see financial markets forever. Let's start with the data, because this 7-year pattern is documentable, verifiable, and observable. Go back to the 1973 oil crisis, which kicked off a stock market decline and economic hardship. 7 years later, in 1980, we had massive inflation and interest rates spiking. 7 years after that, 1987, came Black Monday, where the market dropped over 22% in a single day. Another 7 years brings us to 1994, a year of bond market volatility and rising interest rates. 7 years later, 2001, the dot-com bubble burst was amplified by the September 11th attacks. And of course, 7 years after that was the 2008 global financial crisis. The pattern is there. Sometimes the events hit early in the year, sometimes late, but the 7-year rhythm is consistent. Now, conventional economics will tell you these events are unrelated, just a random series of unfortunate circumstances. But there's an intriguing historical framework that aligns perfectly with this pattern. It's called the Shemitah. The Shemitah is a 7-year agricultural cycle described in ancient texts. Every 7th year, the land was to be given a rest. No planting, no harvesting. It was also a time for financial reset, where debts were to be forgiven. It was a built-in periodic economic adjustment. And here's where it gets interesting. The Shemitah year traditionally ends around August-September on our modern calendar. Think about the timing of the big crashes. September 2001, September 2008, August 2015. The correlation is precise. So, what's really going on? Is this some ancient prophecy playing out? Or is there a more rational explanation? Let's explore a few possibilities. First, human psychology and debt cycles. Economies run on credit. We borrow to grow, but that creates vulnerability. It takes about 7 years for debt to build up to unsustainable levels, leading to a correction, a reset, and then the cycle begins again. It's a natural rhythm of human economic behavior. Second, central bank policy cycles. Central banks, like the Federal Reserve, use interest rates to manage the economy. It takes years for their policies to work. They lower rates to spur growth, which can lead to bubbles. Then they raise rates to fight inflation, which can trigger a downturn. This whole policy cycle, from stimulus to tightening to correction, takes, you guessed it, about 7 years. Third, there's the idea of natural economic rhythms, maybe even tied to things we don't fully understand, like solar cycles influencing human mood and behavior. Or perhaps the ancient wisdom of the Shemitah holds a timeless economic truth. Systems that don't allow for periodic resets will eventually be forced into one by the market itself. And finally, there's self-reinforcing awareness. If enough investors believe a crash is coming in the 7th year, their actions, selling off assets, taking fewer risks, could actually help create the volatility they expect. The pattern becomes a self-fulfilling prophecy. The Shemitah principle was fundamentally about managing debt. Every 7 years, a clean slate. Our modern economy doesn't do that. Debt just keeps piling up. Government, corporate, and consumer debt. But there are limits. When debt becomes too heavy, the system needs a reset. And since we don't do it voluntarily, the market forces a reset through a correction. In 2001, the tech bubble burst, resetting inflated valuations. In 2008, the housing market collapsed, resetting unsustainable mortgage debt. In 2022, speculative froth was wiped from the markets. Every 7 years, it seems the market performs the economic reset our system refuses to do on its own. So whether you see it as an ancient curse, a natural cycle, or just the mechanics of modern finance, the 7-year pattern is a powerful reminder that what goes up must eventually come down. Want to know why the market crashes every 7 years? Let me show you the research that proves this pattern is real and statistically significant. Rabbi Jonathan Cahn published a book in 2014 called The Mystery of the Shemitah, where he documented this 7-year crash pattern in detail. He showed that the biggest stock market crashes in history all seem to cluster around these Shemitah years. The Panic of 1916-1917, a Shemitah year, a 40% decline. The worst year of the Great Depression, 1930-1931, Shemitah year, stocks fell 50%. The 1973-1974 oil crisis, Shemitah year, 48% decline. Black Monday in 1987, Shemitah year. The 2001 dot-com crash, Shemitah year. The 2008 financial crisis, you guessed it, Shemitah year, a massive 54% decline. The pattern is consistent for over a century. Now, mainstream economists say this is just cherry-picking data, and they have a point. You can torture data until it confesses to anything. But here's the thing. Rabbi Kahn's work wasn't just looking backward, it was predictive. He published his book in 2014 before the 2015 crash and warned that the Shemitah year ending in September 2015 would bring economic turmoil. And it did. He warned about 2022, and the markets crashed right on schedule. This isn't just seeing patterns. This is prediction based on a cycle. So how does it work? What causes this 7-year rhythm? It's not magic. It's a combination of 3 main drivers: debt accumulation, central bank policy, and human psychology. Think of our economy as a car and debt as the accelerator. Central banks keep interest rates low to speed things up, which lets debt pile up to unsustainable levels. For about 7 years, this works. The economy grows, everyone feels wealthy, but underneath, the debt is a ticking time bomb. Eventually, something breaks, panic spreads, and the crash begins. This debt cycle, from bottom to peak to bottom again, takes about 7 years. Then you add central bank policy. After a crash, the Fed lowers rates. The economy recovers. But as growth returns, inflation appears, and the Fed starts raising rates to cool things down. The problem is, by the time the rate hikes take full effect, it's often too late. A recession becomes inevitable. From the end of one crisis to the start of the next tightening cycle is about 7 years. Finally, there's human psychology. Markets are driven by fear and greed. After a crash, everyone is scared. But as the recovery continues, people forget the pain. Greed takes over. By year 5 or 6, euphoria sets in. Investors think the good times will last forever, creating bubbles like we saw with tech stocks in 2000, housing in 2007, and crypto in 2021. Then, reality hits, the bubble bursts, and fear returns. This psychological roller coaster, from fear to greed and back to fear, takes about 7 years. It is staggering, as the time it takes for a new generation of investors to forget the last crash and repeat the same mistakes. These 3 factors, debt, Fed policy, and psychology, combine to create this powerful 7-year pattern. But why 7 years specifically? Why not 5 or 10? This is where the biblical explanation becomes compelling. The Shemitah was designed to prevent debt slavery and force periodic resets for social stability. Modern economies reject this idea. We accumulate debt without limits, so nature, or perhaps something else, forces the reset upon us every 7 years through a crash. But it gets even more interesting. This 7-year cycle overlaps with other, longer patterns. There's the 50-year Kondratiev wave, which predicts long cycles of economic expansion and depression. We are now entering what's called its winter phase, similar to the 1930s. There's also the 80-year fourth turning cycle, which points to a period of major crisis and restructuring every 4 generations. The last one was the Great Depression and World War II. We're in a crisis period right now. So, what happens when all these cycles converge? The 7-year crash, the Kondratiev winter, and the fourth turning crisis all point to the same window. The last major crash was 2022. Adding 7 years brings us to 2029. And 2029 is almost exactly 100 years after the Great Crash of 1929. If these patterns hold, the next crisis won't be a normal recession. It could be a systemic event, greater than 2008 and possibly even 1929. You might wonder, if this is so obvious, why don't people prepare? Well, most people don't know about it. It's not taught in schools or reported in the news. And even those who do know often dismiss it as superstition. Plus, the system itself prevents us from stopping it. If everyone sold their assets in year 6, the crash would just happen earlier. Knowledge of the cycle doesn't prevent it. It might even be what keeps it going. The pattern is hidden in plain sight. So, which specific sectors get hit hardest during these Shemitah years? Because the crash isn't uniform across the whole economy. Some parts suffer way more than others. Tech and growth stocks always seem to crash the hardest. These are the most speculative assets, the ones that fly highest during the good times. So when the cycle turns, they have the furthest to fall. Think about 2000-2001. Tech stocks were devastated. Remember Pets, Com, Webvan? Hundreds of internet companies just went to zero. Then in 2008, it was the financial stocks that collapsed. Bear Stearns, Lehman Brothers, Merrill Lynch, gone. And more recently, in 2022, it was crypto and speculative tech. FTX collapsed. Luna went to zero. Many tech stocks dropped 50 to 80%. The pattern is crystal clear. The most speculative, most indebted, and most overvalued sectors get absolutely destroyed. Real estate often crashes too. Housing bubbles build up during the expansion phase. Prices get pushed way beyond what people can actually afford. Mortgages are handed out to people who can't possibly pay them back. When the cycle turns, foreclosures surge and prices collapse. 2008 was the most obvious example. Housing crashed 30 to 40%, leading to millions of foreclosures. The entire financial system almost failed because it was all built on that mortgage debt. But this also happened in earlier cycles, like 1990, 1991, and 1980, 1981. Real estate downturns during Shemitah years are a recurring theme. Commodities can also take a nosedive. Oil, metals, agricultural products. They all rise during inflationary booms and then fall during deflationary busts. 2015 saw massive commodity crashes. Oil went from $100 a barrel down to $40. Copper, iron ore, and agricultural commodities all collapsed. This devastated emerging markets that rely on commodity exports. But the most important one is the debt market. Corporate bonds, junk bonds, emerging market debt. When the cycle turns, highly indebted companies and countries just can't pay their bills. Defaults surge and credit markets freeze up. This is what nearly destroyed the system in 2008. It wasn't just housing, it was the mountain of debt built on top of housing. When the houses crashed, all that debt became worthless and the banks holding it failed. Now let's look at how governments and central banks respond to these crashes, because their reactions get more extreme with each cycle. In 1987, the Fed just lowered interest rates and provided some liquidity. The crisis was contained in weeks. In 2000-2001, the Fed cut rates from 6% down to 1% and injected liquidity. The recession was pretty mild. But in 2008, the Fed went to zero interest rates and launched quantitative easing, creating trillions of dollars. The government bailed out banks and took over failing companies. It was unprecedented. Then, in 2020-2022, the Fed printed $5 trillion in 2 years, and the government sent out stimulus checks and suspended evictions. Each cycle requires a bigger and bigger intervention. More money printing, more government involvement. Why? Because the debt levels just keep rising. Each crash doesn't actually solve the problem. It just temporarily destroys some debt before the Fed makes credit even cheaper, allowing debt to rebuild to even higher levels. It's like treating an alcoholic's hangover with more alcohol. It makes the underlying addiction worse. We're approaching a dangerous point. Total debt in the US is over $90 trillion. That's 350% of GDP. It was 180% in 2001 and 270% in 2008. Each 7-year cycle just adds more debt, requiring more intervention, which creates even more debt. This can't continue forever. At some point, the debt becomes mathematically unpayable. And if the 7-year cycle holds, that big collapse could come around 2029. And this isn't just an American thing, it's global. In 1997-1998, we had the Asian financial crisis. In 2008, it was a global crisis, with European banks failing. In 2015, the Chinese stock market crashed, causing an emerging market crisis. And in 2022, we saw global inflation and currency crashes. The cycle is global because the financial system is global. When the US system has its 7-year crisis, the whole world feels it. Now I know what some of you are thinking. Let's address the skeptics. First, that the pattern is cherry-picked. And it's true, the pattern isn't perfect. But the major, biggest crashes consistently cluster in these Shemitah years. The statistical correlation is very real. Second, that it's just confirmation bias. But the pattern was identified before recent crashes happened. Rabbi Khan's book was published in 2014, predicting the 2015 crash before it happened. That's not bias, that's a successful prediction. Third, that professional investors would exploit it and make the pattern disappear. Well, many do try to time cycles, but it's incredibly difficult. And if everyone sells at the same time, that selling is what creates the crash, so the pattern reinforces itself. Fourth, correlation isn't causation, and that's correct. The Shemitah might just describe an underlying debt cycle without causing it. But that doesn't make it less useful. If a pattern predicts crashes, it's valuable regardless of the mechanism. So, what should you do with this information? First, understand where we are in the cycle. The last major crisis was 2022, so we're early in a new cycle. This is typically the recovery phase. It's the time to build positions in quality assets while fear is high and prices are low. Second, recognize that we're approaching the end of a much longer cycle. The next crash around 2029 might be much bigger. This means being more cautious than usual. Third, position for the inevitable. You can't time it precisely, but you can prepare. Hold some cash for opportunities, some gold and silver as insurance, and reduce your personal debt. Build resilience. And finally, remember that corrections are healthy. Bubbles have to pop. This principle of a periodic reset maintains long-term stability. Fighting the cycle with endless intervention just makes the eventual crash worse. It's better to accept smaller corrections regularly than to risk a catastrophic collapse down the line. Let's look at the deeper implications of the 7-year pattern, because this isn't just about market cycles. It's about understanding economic rhythms. If this pattern holds true, it suggests our economic systems might operate on principles we don't fully understand. Principles that could be natural, historical, or systemic. Conventional economic theory often treats markets as mostly random, assuming major events are unpredictable, and business cycles are just irregular results of policy decisions or external shocks. But if the 7-year pattern has substance, we might need to rethink that. Markets may not be entirely random. They might follow cyclical, even predictable patterns. This has some fascinating implications. It suggests economies have their own inherent rhythms, like natural cycles we see elsewhere. If that's the case, any attempt to completely eliminate these cycles through policy might be like swimming against a powerful current. Interventions might work for a while, but the underlying cycle could just reassert itself later. This could explain why some policies have limited long-term success. They might be fighting natural economic corrections that are actually necessary to clear out imbalances. The ancient Shemitah principle offered a different approach. Work with the cycles, not against them. Instead of letting debts pile up forever, it called for periodic resets. This allowed for regular, smaller adjustments to prevent larger, more disruptive crashes. Think about it. Historical economies with periodic debt forgiveness may have avoided certain kinds of economic stress and maintained better social balance. Modern economies don't do this. Obligations just accumulate and compound until the market forces the painful adjustment that wasn't made voluntarily. The 7-year cycle might just be the market's way of enforcing this reset. Now, let's look at the political dimension, because this pattern isn't just about money. It seems to correlate with major political changes. Think about it. Periods of economic stress are often when we see big political shifts. In 2001, we had major national security events that fundamentally changed policy priorities. In 2008, leadership transitions occurred right in the middle of economic crisis, leading to a new era of government intervention. In 2015, new political movements gained steam worldwide. And in 2022, we saw intense electoral events and policy debates. The pattern suggests economic stress can be a catalyst for political change. When people face financial challenges, they're more likely to seek different leaders and new policies. It makes sense. And if economic challenges tend to show up in 7-year intervals, it's logical that political openness to change might follow a similar timeline. This would suggest the next major political transitions could line up around 2029, during the next potential period of economic stress. And if that period is significant, the political changes could be substantial. Some researchers offer an interesting interpretation. The Shemitah wasn't just an economic practice, it was a moral principle designed to promote economic fairness and prevent excessive concentration of wealth. They suggest that modern economies, which operate so differently, might experience these cycles as a natural corrective force. When debts become unsustainable or wealth becomes too concentrated, the market finds a way to rebalance itself. This view sees the 7-year cycle as a self-correcting mechanism, an analytical observation rather than a prophecy. It suggests that balance eventually reasserts itself about every 7 years with observable regularity. So, how can we apply this knowledge? First, recognize where we are in the cycle. The last major period was 2022, which means we're early in a new 7-year interval. This is typically a time of recovery and rebuilding. It's often a good time to consider opportunities while others are still concerned and valuations are lower. Second, understand we might be approaching the end of even longer cycles, not just a 7-year one, but maybe even a 49-year jubilee cycle. This could mean the next period of stress around 2029 might be more significant than usual. So, it might be wise to be more conservative and not assume the next cycle will be an exact repeat of the last. Third, prepare for these patterns. You can't time the market perfectly, but you can be ready. Maintain some liquidity, hold some traditional stores of value for diversification, and reduce unnecessary debt. Build resilience. And finally, remember that corrections serve a purpose. They address debt and adjust valuations. Trying to prevent every small correction might just lead to a much bigger, more painful adjustment down the road. It's better to accept regular, smaller resets than to risk a massive one later. So here's my final question for you. If market stress really does occur in 7-year intervals with statistical regularity, what does that suggest about the nature of our economic systems? Drop your answer in the comments and tell me if you find this pattern compelling. Will you be watching 2029 with this framework in mind? Hit subscribe for more pattern analysis and economic history. Share this with anyone interested in market cycles or planning their financial future. The pattern continues, the cycle persists. Understanding it doesn't guarantee outcomes, but awareness allows for better preparation. Are you prepared?